Good afternoon to all of you for giving us an opportunity to share our views on the market and present you some of the very interesting thematic opportunities. Let me start with the market outlook. So, if one question which is there in everybody's mind at this point of time is that we have seen a very sharp rally in the market, not only in just last 1 month, even if we look at the YTD period or last 12 to 18 months, we have seen a very, very sharp rally in the market. And key question which is there is that has the valuation kind of moved up very sharply, or is it time to book the profit? So before touching upon that, let me give you some context. If we look at the India macroeconomic situation, India's GDP is expected to grow somewhere around 6.5 to 7% in the current year, and this is something this number which has been revised upward by around 50 basis points by most economists in last 6 months. So growth is something which has been surprising on the positive side. At the same time, when we look at the inflation, inflation is something which is well within the control and the number is within the comfort level of RBI. RBI has certain range in mind as far as the inflation is concerned, and it is well within that range. So overall, there can be some minor short-term movement in inflation which can happen due to the monsoon, because monsoon is unpredictable, and if there is an adverse monsoon or below normal monsoon, it can lead to slightly higher food inflation, which can lead to a slightly higher overall inflation. But that would still be very, very short-lived. Overall core inflation is very, very benign at this point of time, and hence our outlook on inflation is something where we don't really expect any very sharp upward movement on the inflation. And hence, if we look at the overall scenario, we have a very good growth rate and interest rate and inflation, which is well within under control. So based on both of these factors and some of the other factors, we expect that interest rates seems to have peaked. And from here onwards, interest rates is expected to come down. Timing is still uncertain in terms of when exactly it will start happening. But we expect that over say next 12 to 18 months, we will see an interest rate which will be much lower than what is currently prevailing in the market. And hence, if we look at the overall macro situation of India, we are in a very, very comfortable position. And this is not just in the Indian context, it is, if we look at globally also, Indian economy is one of the more resilient economy globally. And this is one of the reasons why most of the global investors are also looking at India in terms of investment. Even if you look at, there was some bit of uncertainty in their mind with respect to election, but post-election in last 1 month or so, we have already seen around $3 billion of inflow. So we believe that FI flows is something which should continue to be on a positive territory. Domestic flows are something which is continuing. So overall, most of the macro factors are very, very favorable. And on back of these favorable macro factors, what we have seen is that the earnings growth of the corporates has been something which has been on a very, very positive trajectory, where they have seen a big turnaround in terms of growth. And we are also seeing a lot of positive surprises in terms of earnings growth. So if you look at the earnings, corporate profit as a percentage of GDP, it has been coming down in say last 10 years, but in last 3 to 4 years, it has started to again move up very, very sharply. And even if you look at the growth, if you look at say last 10 years growth, say between say FY 10 to 20, the growth was very, very limited to mid-single digit. But in say last 5 years or last 3 to 4 years, it has moved up very, very sharply, and we expect the similar kind of growth to continue for the next couple of years. So one key thing, one key concern which everybody asks is the valuation, where the market has moved to an overvalued zone. So here I would like to just classify large cap and mid cap and small cap in a slightly different bucket. So when we look at the large cap, the valuation are closer to their historical average. So if you look at the last 10-year average of the large Nifty 50 evaluation, current valuation is closer to that number only. So again, this is again on back of where we have seen the fundamental of these companies improving, where you can see that ROE of most of these companies, Nifty 50 companies, have improved from say 12-13% to around 15-16% currently. So based on this, we, at least as in the large cap category, we don't really see any major concern on the valuation. However, what we have seen over the last 18 months is that mid and small cap has kind of outperformed the large cap, where they have given a far superior return. And if we, based on those return, if we look at the current valuation of the mid and small cap segment, yes, it has moved up a bit, and they are trading above one standard deviation compared to the historical average. But this is again in the normal volatility zone. It is not something where it has kind of moved up to 2 or 3 standard deviation above, where we should be really worried about. And we also need to look at this valuation in terms of the expected earnings growth. So both for the mid cap and the small cap, the earnings growth momentum is something which is expected to continue to remain robust, and they are expected to continue to show a very, very handsome earnings growth. So as long as we have a visibility on the earnings growth, we don't really see valuation as a major concern. Obviously, we need to look this in terms of from the bottom up perspective, and we need to look at from the individual company perspective. But given the fact that the Indian economy is in a very good shape, the flows which are happening, flows which are coming to the market are continue to remain healthy. And the earnings growth is something again which is again remaining very, very robust. So in this context, I don't really see any major reason to be really, really worried about the market. They can, because of very sharp rally in say last 1 month, so on a YTD basis, we may see some time correction which may happen, or there may be even some minor correction which may happen. But those should be something which should be taken as an opportunity rather than we should be fearful at this point of time. So we are, again, remain very, very constructive on the overall market. Now, given this backdrop, now let me touch upon 2 themes. First one is the consumption theme. We are really excited about this theme, not from next 1 year or 2 years perspective. We are really excited about this theme for next 5 to 10 years perspective. And mainly, first of all, let me just clarify over here is that when we talk about the consumption, most people associate consumption as a FMCG sector fund or as a FMCG sector theme. But this consumption theme is far broader than that. So if we look at the last 10-year data, if first of all, FMCG sector has also kind of grown at a very, very rapid pace, where the combined market cap of FMCG sector has increased from almost 5 lakh crore to 22 lakh crore. But apart from that, there are a lot of other sectors or sub-segment of consumption which have come up and now become very, very large. So like hospital was very, very limited, say 10 years back, where there were only 3 hospitals which were listed. And now we have around 14, 15 hospitals which are listed. And the combined market cap of those companies are almost 60 to 70% of the entire FMCG sector market cap, which was there 10 years back. So there has been a lot of new sub-segment which has emerged in the consumption space. And those are becoming very, very large. And they are, in fact, some of these sectors are growing at a very, very rapid pace. So this is a very, very large opportunity. And in our view, one should look at this opportunity more of a thematic fund where it captures almost around 60% of the market rather than one particular sector fund. So that is one aspect which I would like to highlight. Now, coming to the fact that why we believe that this is one area or this is one thing which should be very good or should give a superior return over, say, next 5 to 10 years. This is mainly coming from 2-3 factors. So first major factor is that what we have seen that whenever a particular country crosses a milestone of $2,000 of GDP per capita, in the following 10-15 years, they have shown an accelerated growth in their consumption. India has crossed that milestone about a couple of years back in CY19, and obviously they have following that next few years got lost due to COVID. But now we have already started seeing a very reasonably decent growth in the consumption sectors, and we believe that next 10 years would be very, very great space for the Indian consumption sectors. And this is again, as I highlighted, not but just FMCG, but there has been a lot of other discretionary categories which will kind of grow at a very, very rapid pace. And another very important factor which we need to keep in mind is that India is very, very favorably placed in terms of demographics. So if we look at various household, uh, most of these household, whether it is where we are looking at elite or affluent or aspire, these are the three major ones which actually spend a lot on the discretionary consumption. And the next billion is something which really spend a lot on the staples kind of product. These are something which is expected to grow at a very, very rapid pace. And the people who actually are in the struggler segment, which actually just meet their ends, these numbers or number of household in this category is coming down. So over next 10 years, what we will see is that not only the existing consumer will keep consuming more based on their income growth or based on their demand growth, a lot of new consumer will come into the kitty where they will also start consuming at various price point and at various segment. And that is something where we should lead to a very, very rapid growth in the consumption, particularly the discretionary consumption. And just to give you some highlight that Indian consuming class is expected to become double in next 5 years. So again, we will see a very large addition to the consuming class over next 5 years, and which will drive the consumption for India. And here also one very important point I would like to highlight that we also need to see that women in India is now increasingly more and more participating into the workforce. So when this happens, a single household income becomes a double earning household income. And this lead to a very, very substantial change in a household expenditure, because the moment it becomes a two in a typical household, if the moment two people are earning, they end up spending a lot more on the consumption, and particularly the discretionary consumption. And this is something we expect this trend to continue over say next 10 years, where more female will continue to participate in the workforce, and hence more and more household will become double income household. So these are some of the aspects because of which we expect a very, very significant increase in the consumption in the coming years. Now, coming to the spending pattern, one important factor which we have seen is that Indian population is very young, and the newer generation tend to spend a lot more on the consumption compared to the older generation, mainly because of they are far more influenced by the social media. And because of that, again, we should see a much more accelerated growth in the consumption. So having established the fact that we will see accelerated growth in the consumption, what we have also want to highlight that there are certain themes within the overall consumption category which will grow at a much faster pace, and hence we need to really look at some of those themes. One such theme is the opportunity and the penetration. So if we look at a lot of consumer goods, whether we are looking at say AC, currently India has around 6 to 7% penetration of AC compared to say around 53% penetration in China. So there is a very long tail of opportunity where the penetration of AC as a consumer good will keep on increasing, and hence the growth of say wide durable like AC will be far greater than say some of the more penetrated categories, say refrigerator. Even if we look at the refrigerator in India, currently it is just 35% penetrated. compared to almost 90 to 80%, 90 to 100% penetration in most other countries. But still, given that some of the other categories has a much lower penetration, the growth of those categories would be much higher. And this is one example which I have touched upon. If whether when we look at even the services sector, there are so many opportunity on the penetration, and hence some of these categories will grow at a faster pace than the overall consumption in India. Second, such theme is the shift from unorganized to organized, where there has been, because of the government push towards GST, government push towards formalization of economy, we are seeing that a share of organized player gaining market share from the unorganized player. And again, this is something which we have seen in case of retail or jewelry or real estate, where they have been continuously gaining market share, and hence they are growing at a much faster pace compared to the overall category growth. And again, this is again one very interesting theme which is there. The third theme which is there is of premiumization, where what we have seen is that there are certain categories. What we have seen and what we have highlighted earlier, that the premium or affluent class of India is growing at a much faster pace compared to the overall population growth, and hence their household income is growing at a much faster pace, and hence they are consuming more of a premium product compared to the rest of the household. And this is something where we have seen, like, just to give you an example, if you look at the bike, say 250cc plus bike, that used to have just 2% penetration or 2% market share in the overall bike sale in, say, 2014. But fast forward 10 years, that 2% has increased to 8%. And again, this is just one example. There are so many examples where we have highlighted that where people are moving towards more premium product, and hence some of these products are growing at a much faster pace compared to the overall category growth. And lastly, the government push towards the digitization and UPI is leading to growth in some of the new age economic or new age companies, where they have been able to leverage the technology and hence able to deliver a fast superior return. So these are some of the themes within the overall consumption category, where we believe that these themes will really push the growth at an even higher level. And we have positioned our portfolio in such a way that we should be able to take advantage of this theme. So just to give you our portfolio positioning compared to large cap, compared to the benchmark, if we look at our portfolio, we are far more diversified in terms of both market cap as well as in terms of sectors with subsectors within the consumer. So there has been a lot of subsectors which are underrepresented in the benchmark, but we try to be mostly bottom up, where we have tried to look at those companies on an individual basis and try to position our weightages based on the outlook of those particular sector and outlook of those particular company. And hence our portfolio is very, very different from the index and some of our peer group. And we have largely constructed our portfolio based on the bottom-up approach. And this is something which has worked well for us in, say, last 8 months. And again, we believe that this is something which will continue to help us in the coming years. So these were the key points which I wanted to highlight on the consumption theme. Again, very quickly, given the interest of time, I will quickly move to the infrastructure segment. Again, this is something which is a very, very exciting opportunity, mainly coming from the fact that India is currently in a situation where we can say it is infrastructure-starved country. There has been ample opportunity to invest on the infrastructure, and government focus on infrastructure has increased in, say, last 5 years. So we have already seen that government capex has been increasing, and particularly in, say, last 3 to 4 years, when we are looking at the center's capex, the center capex is something which has been growing at a very, very rapid pace. Last couple of years, the state government capex was kind of was kind of stable, but we again have seen growth in the state capex in say last 1 year or so. Private capex is something again which was kind of stable, but we have started seeing early sign of acceleration over there. And when we are looking at the corporate balance sheet, most of the corporate balance sheet is in a very, very healthy space. And hence, as the economy is picking up, as the demand is improving, these companies are looking to do more and more capex. And hence, private capex is also something which is picking up. So what we have seen that over say last 2 or 3 years, it was mostly one or 1.5 engine which was firing. But now over the next 2 years or 3 years, we will see all the infrastructure engines which will fire, where we expect that infrastructure capex is something which will continue to grow at a very healthy pace. If we look at the breakup of the infrastructure segment, I will touch upon few areas where we expect a very, very sharp investment which will happen. One is the overall transportation segment, and that would be very large quantum of investment in the overall infrastructure segment. When we are looking at transportation, here there are two further sub-segments, which is road and railways. So road is something which has been again very steady. There has been cycle within the road segment where every few years we see a good growth, and then there's been a bit of a taper which happened. Again, but overall, at a overall level, we have seen the good awards which is continuing. So that is something, if you look at say FY24 number, we have already seen a dip in the road awards in FY24, but again, we are seeing more and more bids which are coming out in the first quarter itself, and hence the outlook for 25 looks very, very interesting. And hence, again, the road is one area which will continue to see a very good traction in terms of award in FY25. And again, the longer term pipeline, when we are looking at the next 3 to 4 years, look very, very strong in terms of road awards. Railways is again one area where we have seen a very significant focus which has come up. So if you see the bottom chart, the overall cumulative capex in the railways in last 10 years is almost 5x of the cumulative capex which has happened in the previous 10 years. So we have seen a very significant upward movement on the railway side, where government is trying to augment the capacity. If you look at the last 10-year capex, the more focus area was mostly on the track laying and electrification and broad gauge conversion. Now the focus is again moving also on the rolling stock, where government is procuring a large quantum of wagons. The government is looking to modernize the passenger transport with the launch of Vande Bharat. High-speed railways is something also which is currently under work, and we should see that also getting commissioned in say next couple of years. So again, there has been a lot of investment which is happening on the railway side, both on the rolling stock locomotive as well as the track laying or electrification work. And one thing which is very, very clear over here is that government is looking to modernize the overall railway network. And that is where we have already seen that government is incrementally looking to launch more and more Vande Bharat trains, which is much more modern and much faster running train. But again, here I would like to highlight one fact that though these trains can run at say at a speed of say 150, 170 kilometers per hour, but on the current tracks they are only running at say 120 kilometers per hour of speed. And that is where over the next 4 to 5 years, government will also spend on upgrading some of these tracks so that these trains can take full advantage of their own speed. So overall capex on the railway is something which will continue to continue to remain strong. Metro is another area which is coming up where we are already seeing a steady growth in the capex, and most of the cities have now already have a pretty good metro network, and every city is looking to augment their metro networks, where they keep adding of new lines of metro network or keep setting up a new projects on the metro side. So that is also something which is continuing to grow at a very healthy pace. Another very major area is the powers or energy sector. So if we look at the previous cycle, energy was a very large part of the previous capex cycle, which was between say 2003 to 2008-9. However, over last 10 years, the spend on the uh, power side was relatively limited, and whatever spend which was happening was mostly on the renewable side. But in last 1 year, what we have seen is the government focus on renewable is something which is continuing. But now thermal award is also happening, where government is realize the fact that for the base load we will need a thermal power plant also. And since there has been no major investment which has happened in last 10 years, we need to kind of again start looking to invest in the thermal capacity. So we have seen some awards which has happened in say last 6 months or so, and again the pipeline look very strong for next 2 to 3 years. And on back of this investment on the generation side, whether we are looking at thermal or the renewable, we also now seeing a bit very good traction in terms of capex or order award on the T&D side, or transmission and distribution side. And that is again one area where we see a very good growth to happen. And that is again one area we have kind of positioned our portfolio adequately. Uh, so these are the two major segments which we have highlighted. There are quite a few other sectors like defense, which is kind of picking up very, very significantly as the government is focusing more on the domestic manufacturing. So overall defense expenditure is growing somewhere at a high single digit or low double digit growth. But since the government is more trying to source more and more product from the domestic manufacturing companies, these companies are growing at a very much faster pace. So that is something again which is growing at a very good pace. Water is again one area where government has a very large plan, and that is again one area where they have been continuously spending. And this is again one area which is showing a very good traction. And one area which has kind of emerged over last 2 3 years is the manufacturing. Government has now started to focus a lot more on the manufacturing in India, whether we are looking at the electronics or the chips or essentially government intention is trying to substitute most of the import it is doing from the domestic manufacturing. And this is something again which is giving to a lot of flip both on the traditional industries like cement, steel, power, as well as a lot of the newer factories are coming up, whether we are looking at the electronic manufacturing facilities or chip manufacturing facilities. These are something which is coming up. So again, all these factors are leading to a very, very sharp growth in the on the infrastructure side. So the main point I would like to highlight is that uh, overall we have seen a very, very good growth on the capex over say last couple of years, and on back of that, this sector or this theme has done very well. But we believe that given the current government is continuing and their policies are expected to continue, we don't really see any slowdown in the order award or capex. And what we typically do is, apart from the overall macro factors, we also keep monitoring the order flow or order award which is happening for a lot of these companies. And what we have seen over say last 1 year or so is that most of these companies has been surprising positively on the order inflow side, and which gives us a very good visibility for next couple of years. And again, we expect the momentum to continue, given the government focus should continue to be remain. So again, this is one space where we continue to remain positive for next 2 3 years. And though overall theme is there for next 5 to 10 years also, where given the infrastructure need of the country, this is one area where we will see continued investment being made by all the three segments, whether it is private sector or whether it is a center or state government capex. Again, in terms of our portfolio, what I highlighted over in terms of consumption portfolio, that we largely follow a bottom-up approach where we try to construct our portfolio irrespective of what are the weights in the benchmark. We don't really try to hug the benchmark. We try to evaluate each company based on their merit and accordingly try to take a decision in terms of what kind of weight we want to have and what kind of positioning we want to have. And we are again very happy with our current portfolio, and this has done well, and we again expect this portfolio to continue to do well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.